I managed to start a recording.
Oh, okay.
Okay.
Yeah, it's
Thank
recording
you.
now.
Thank you.
Okay, perfect. All right, well, let's jump back into it. So all I was saying is that all of the content that we're going to be discussing today, you already in theory have access to. So uh, I think someone on the call, if you could all mute yourselves, there might be a little bit of an echo, so that could keep it under control. But yeah, hopefully this is going to be familiar to you all. And if not, we put some time at the end of the presentation for a bit of a back and forth on Q&A, and I'm happy to go into any of the topics in a bit more detail than I presented in the PowerPoint here. So let's dive into it. There are three main topics I want to talk about today, which range from the broad and will kind of progressively get a bit more narrow as we go on. So we'll set the stage with our global outlook, looking at our economic and political projections for the next 5 years, which is what EIU calls our core forecast period, even though in theory we have forecasts to go out to 2050, but we can talk about that separately. The next thing we'll talk about is supply chains or supplies unchained, the turmoil that's impacting global trade right now, which is kind of what I follow very closely in my day-to-day as the lead analyst for global trade, as well as from then we'll move on into the future of trade multilateralism and what this means in terms of things like cooperation among states when it comes to trade agreements, as well as the increasingly dire geopolitical outlook that's facing particularly the Asian region. So let's get into it by starting off with the EIU's global outlook for the next 5 years. So there are a number of key themes that we're looking at, which hopefully isn't going to be too foreign to anyone on this call. As an analyst, I'm constantly overwhelmed by the news headlines. And one of our jobs at the EIU is to try and distill everything that's going on into some of the key takeaways that we think businesses, governments, multilateral institutions like yourself should be really following. And so these are the six kind of issues, the six main issues that we're looking at in terms of what we think is going to define the economic policy and political trajectory over the next 5 years. And that ranges from supply chains and the localization of supply chains, issues around commodities and what that means for inflation, the discussion around the green transition, as well as how growth constraints right now might be frustrating that agenda, weaponization of business. So, for example, how multinational companies are getting caught in between rival political structures. So that's mainly a question of say, the China and Russia aligned world with the non-China and Russia aligned world. Next, we have issues around the politicalization of technology. And then finally, we have a discussion on the current themes on rising interest rates, policy tightening, and this movement towards the end of an era of cheap capital and what this means for global economic growth, but also things like inflation, consumer sentiment, and kind of setting a new, I hesitate to say post-pandemic normal because the pandemic is not over, but kind of the new normal of what it looks like after 2+ years out from COVID-19. So let's look at some of the numbers. Overall, we are expecting global growth of 2.8% this year, which is down from around 4% before the war in Ukraine started. Now, the drags on global growth are different by region, and you can see in this chart what's exactly happening. So a lot of the story that we're seeing in the West, which again, is not going to be a big surprise for any of us on the call, is directly tied to the conflict in Ukraine. You can see in that call out box on the top, we're expecting pretty severe recessions in Russia and Ukraine. But as a result of the turmoil there, we're expecting a pretty big drag on Eurozone growth, down from 4% to 2.3%, with growth really stagnating for the rest of this year, with recessions in economies, major economies like Germany, Italy, Turkey. If we kind of look across the pond to the US, we're expecting US growth of around 2.3%. A lot of that is owing to high inflation, which again is tied to the Russia-Ukraine war, primarily the impact of higher oil prices. This kind of fits into this overall story around high global inflation. We're expecting 8% average inflation this year against around 5.5% in the pre-war period. And that has consequences for the emerging market world. So for example, Latin America, we're expecting to suffer kind of in different ways from global inflation, even if commodities exporters are going to benefit from those higher prices. That's going to be a similar story for the Middle East. The one area where a lot of this narrative differs is Asia, where the impact of the war in Ukraine has been relatively contained. Asia has pretty limited exposure to what's going on in Europe. And actually, the main story there is what's going on in China. where we're expecting growth to slow to 4% this year. And that is primarily a story around the COVID-19 control policies that are still very much in effect in that market. This so-called dynamic COVID framework or zero COVID framework, which is still guiding healthcare policy and by extension, economic policy. This is something that I'm sure many of you are on the call are familiar with, but if you're not, zero COVID refers to this idea that the government is trying to completely eradicate COVID within its jurisdiction. So even one case can place an entire city under lockdown. We're expecting the zero COVID framework in China to persist until at least the middle of next year, which is going to contain and have some carry some pretty deep consequences for not just growth in China, but for the wider Asian region. So as part of this, we also look at a number of risks that are part of the global economic outlook. A lot of this ties to the geopolitical landscape. So the deterioration in relations between China and the US, China and the EU, that's something that poses a very big risk to businesses, as well as the continuity of supply chains, as well as just diplomatic optics more generally, as we start to see just increasingly strained tensions between, again, kind of this Western aligned order and this Chinese order, essentially. We have some other kind of concrete risks that we're looking at very closely as well, which I'm not going to spend too much time on, but I'm happy to discuss in the Q&A if there's questions. That includes the potential of a conflict in the Taiwan Strait, the potential of the war in Ukraine spilling over into a global conflict. And then we have other things which are going to have an impact on kind of our day-to-day lives. So for example, we are expecting a new COVID-19 variant to emerge in the second half of this year. There's a risk that it could emerge as a more highly aggressive variant. What we've been seeing over the past couple of years has been an increase in contagiousness, but a decrease in severity. If we were to see a new variant that is more contagious and more severe, that could really have some dire effects for the global economy, particularly given that it's looking like we need at least 3 to 4 doses of our current vaccine schedules to kind of maintain this operational normality, which when we think about developing markets, particularly in Asia, Latin America, and Africa, that timeline is very far behind. And that's something that is quite worrisome. The final thing I'll mention, which is a bit more of a long-term view-ish, is climate change, where, I mean, we're already seeing news of extreme weather in the UK, in parts of Southern Europe. I mean, even in the US, it's a lot hotter than I remember, and I haven't been here for a couple of years, but I mean, it all speaks to the fact that the problems around climate change are very real and they're here now. And that's something that is going to weigh on global economic growth, maybe in quieter ways than things like China's zero COVID policy or the war in Ukraine, but in noticeable ways anyway, and in ways that will influence policy over the next decade. So as part of this, one of the topics that we're also looking at is this issue around food insecurity. This is tied to our global commodity price outlook, as well as disruptions and dislocations from the war in Ukraine. This map here is just our assessment of the countries which are most exposed to food exports, specifically wheat from Russia and Ukraine. And I think Russia and Ukraine account for around 25% of global wheat exports. You can see that this is primarily, again, developing world story. And this is happening at a time when global inflation is at incredibly high levels. And so already we're seeing households which have already been battered by COVID-19 under significant pressure from, say, global fuel prices. Higher global food prices threaten to kind of inflict another type of humanitarian disaster in ways that could be very potentially politically destabilizing. So for example, the developments in Sri Lanka over the past couple of weeks, where we've seen the resignation, essentially the capitulation of the government, a lot of that ties to these soaring food and fuel prices. And so the political consequences and the economic consequences of this can't really be understated. So this is going to be a bit more of a technical slide, so I'm not going to spend too much time with it. But when we move into this kind of new normal after the pandemic, one of the things that we're looking at very closely is how the credit landscape looks for particularly emerging markets. We saw a really significant expansion of credit policy and a kind of a loosening of credit policy in 2020, 2021, as governments moved to shore up economic activity and to protect themselves from disruptions caused by COVID-19. But now we're in a tightening cycle. That means we're thinking about how can policy rates come back to normal? How can governments withdraw their stimulus? But what does that mean in an economic world where there's still so much fragility, there's still so much economic uncertainty, there's still so much pressure facing businesses and households? So one of the things we're looking at in terms of sovereign debt risk and the potential of countries defaulting is exactly this topic. in terms of what might be happening. This is part of a product that we call the Country Risk Service, which you might all have access to. And so for those of you who are interested in this topic, I'd suggest you to follow this product suite closely. And it looks at things like the types of macroeconomic fundamentals that could be flagging issues in a market. So for example, the repayment issues that we're seeing in Sri Lanka, the emerging economic distress that we're seeing in Pakistan, these were all things that emerged on our radar actually a couple of months ago because of our monitoring this issue via this model. So, and this just kind of ties into that. This ties in that last bullet point that I mentioned in the first slide, this era of cheap financing, whereby credit for a long time was just very, very easy to access. That's changing as US interest rates rise, as the US dollar strengthens, as capital from emerging markets leaves and leads to currency depreciation. This again is going to be primarily a story for emerging markets and kind of developing countries where macroeconomic fundamentals are more fragile, or credit fundamentals are a bit more riskier. And so I think for anyone on this call who's following particularly markets in emerging Asia, Africa, Latin America, this is probably going to be one of the dominant themes that we're going to be starting to see emerge over the next 5 years. So let's bring it back to Asia. I am an Asia analyst after all. And part of the idea of me being here is to kind of provide the perspective from that part of the world. I also like talking about Asia because a lot of what's happening in terms of the global economy is really centered in that part of the world, given Asia's incredibly important footprint in the trade landscape. Asian GDP growth, we're expecting to be at 3.9%, which is actually pretty high when benchmarked against other regions in the world. But there are going to be disparities. And as I mentioned before, a lot of this is going to come from slower growth momentum. There are going to be fundamental issues that are going to influence how all of this evolves over the next couple of years. So for example, I just talked about the capital outflows to developed markets away from emerging markets where there are higher yields and security. But we're still expecting Asia to be a relatively important kind of player in the global economic landscape. So for example, there's been a lot of discussion around the US and China kind of economic rivalry in Asia specifically. But I think people will forget that the US actually is a huge investor via its companies in Asia, despite China's economic heft, despite China's push with the Belt and Road Initiative, despite its efforts to push its tech companies to invest more in emerging ASEAN markets in particular. And that's going to remain, particularly as we start to see greater trade integration in that region, which I'll talk about a bit later. But this theme of a geopolitical split derived from the US-China rivalry, that's going to be another main theme that we're going to see kind of contextualize what's happening in Asia over the next decade. So let's talk about the US really quickly, just because I imagine a lot of people who are based in New York are probably following this issue very closely. We at EIU are not expecting a recession, though I would say that this is a very finely balanced call. And the risk of a recession, I think our US team is placing at around 40% to contextualize our core forecast, which essentially means the things that we write about that we think are going to happen. That normally has a probability of around 50%. And so that's all that is, just to explain that there is a very high risk that things could turn really ugly really quickly. Our assumptions for how the US is going to avoid a recession are primarily predicated on the resilience of consumer demand. That partially, can be reflected in the really high inflation prints that we've been seeing over the past couple of months. The really strong import volumes that we're still seeing at US ports. Consumer demand still looks pretty strong, even though consumer sentiment has fallen to pretty low levels. And so there seems to be a bit of a disconnect here in terms of how people feel about the economy, but their actual behavior. At the same time, things could really turn ugly if we see another double-digit inflationary spike in the coming months. We are expecting inflation to peak around this in the third quarter. If that doesn't happen, then this could change our forecast quite substantively. There's a risk of a Fed overcorrection. So, for example, a higher hike in interest rates than we're currently expecting. So, for example, we're expecting the Fed to raise basis points by 75 points next week. If it were to raise it by 100 basis points, which seems increasingly unlikely after the news cycle this past week, or more, then that could really push consumer sentiment to new lows and business sentiment to lows in ways that could impact actual private consumption and gross fixed asset investment in ways that could prompt a US recession. And then as part of that, a collapse in US asset prices, something that would have negative effects on wealth, and also, again, that those feelings on consumer confidence, all of which could spell some trouble for the recessionary picture. And so again, this is not our core forecast of a recession, but I do want to lay out kind of the factors that we think people need to be watching and to be looking out for to see what might the potential triggers be to this so-called risk to our forecast. Let's bring it back over to Asia and talk a little bit about China, second largest economy in the world. So the key takeaways I want to emphasize here are that we're expecting real GDP growth again of 4% this year. But growth here is not going to necessarily reflect a very positive picture. So this morning I was watching the news, and there were a number of people on Bloomberg talking about how China has kind of saved the global economy in years past, how its stimulus measures have kind of been a rescue package. That is very much the kind of analytical picture that we saw in 2008, 2009 during the global financial crisis, when China unleashed this massive 4 trillion renminbi stimulus that kind of propped up the global economy. Things are very different now. The growth that we're seeing in China is almost exclusively being led by the state. I'm talking about state-owned enterprises, public investment in infrastructure. We are not seeing the same type of resilience in household spending or in private business spending. And that is primarily owing to the zero COVID policy. I'm not sure how many people are familiar with what zero COVID policy means, but to kind of give an example of this, this is a real example from our colleagues in Shanghai. If you live in a xiaoqu or a residential compound and there is one case or one suspected case or someone who's friends with a suspected case, your entire residential compound might go under lockdown for at least 1 to 2 days. That is incredibly disruptive for businesses in terms of planning. That's disruptive for consumers in terms of, you're not going to want to leave your house, or if you do leave your house, you're not going to be spending on discretionary items. You're going to be stocking up on groceries or staples because you don't know how long you might be under lockdown, which if we remember what happened in March to May, Shanghai was essentially under lockdown for about 2 months. There are some really horrific stories coming out of there. For as long as the zero COVID policy persists, which we at the EIU are expecting to persist until the middle of next year, this is going to be a huge drag on private investor and private consumer sentiment in ways that depress private spending and among households and among businesses. And so this is something that is going to necessitate any kind of Chinese growth that we see at all this year to really come from the state sector. Now, what does that mean in terms of that context of China bailing out the international economy? My view is that this isn't really the case anymore. State-driven activity means that there's going to be demand to a degree for commodities. So if you're an iron ore exporter from Australia or a coal exporter from Indonesia, this might be good news for you. But if you are in the auto industry and you're selling cars, or you're selling cosmetics, or you're selling consumer goods, you're selling luxury goods, this growth number doesn't really mean much to you because it's not being derived from parts of the economy that you care about. And so when we think about China saving the global economy, I kind of question that narrative because the imports that it might be using to support global demand, that's going to target a very specific subset of countries. It's not going to necessarily, target the types of exports that are coming from the EU or from the US. And so we need to be very careful in terms of how we contextualize this. At the same time, when we also think about Chinese growth, the non-investment that's happening is coming from exports. And so in some ways, China is actually quite reliant on the health of the global economy beyond its borders to kind of maintain demand for the products that China itself is producing, which I'll talk a little bit later in terms of the trade outlook, but it suggests that the fundamental relationship between China and the global economy is shifting. Now, this chart that I have here on the right comes from a product that we call Access China, which I think I saw on the screen you all have access to. Access China is just a product suite that looks at the Chinese economy at the provincial and the city level, which I think is critically important because the economy in Beijing or Shanghai is very different from what's happening in Xi'an, Harbin, Changchun. Chinese economy is incredibly varied and diversified. And so this Access China suite allows us to see what's happening at the subnational level and what's happening in terms of shock to supply chains or where growth might still be resilient. This chart is part of a forthcoming analysis that looks at congestion levels in terms of the past half year, and it shows which cities might actually have been a bit more resilient in terms of their COVID-19 mitigation strategies vis-a-vis their counterparts. And so you can see here some of the really big cities like Beijing and Shanghai are kind of ranked all the way at the bottom, where you have some smaller cities like Fuzhou, Shijiazhuang, Taiyuan, these kind of tier 2, tier 3s that people aren't really aware of, kind of topping the charts. And so I think I'd encourage for anyone who has an interest in China or economies that are linked to China, understanding the growth picture beyond the headline numbers is quite important, and making use of this service is quite critical as part of that goal. So let's bring it back a bit more broadly before we start talking about the trade environment and just have a quick discussion on our outlook for the emerging world. And so these charts on the left are just some quick illustrations of where we're seeing real GDP grow, where we're seeing investment and private consumption go over the next 5 years. And so again, this is going to be a very diversified kind of narrative. So in ASEAN, a lot of the story here is tied to trade, but geopolitics are the emerging story. And I've said this a few times, but we're going to come back to this, I promise. In Latin America, the story is mostly around high commodity prices, as I talked about. But this is going to have, again, kind of disparate influences in terms of what happens in the economy, in terms of how inflation is going to erode household spending, but it could buoy export receipts. In the Middle East and North Africa, we have some similar issues there, but the one thing I want to talk about, which I mentioned earlier in the presentation, is those topics around food security, which really could require IMF or other multilateral intervention. And then finally, in sub-Saharan Africa, that similar food security issue is very prominent. But some of those issues around debt and balance of payments strains, those are going to be particularly pronounced over the next 5 years, with this becoming a lot more emphasized in what we call the later part of our forecast period, so 2024, 2025, 2026. So with all of that as the background, let's get into trade and supply chains. I think we can't really talk about trade without looking at what's going on between the US and China, particularly given all of the news in the last couple of weeks around what's happening with US tariffs. Our view at the EIU is we're not expecting the US to lift most of its tariffs on Chinese goods, even though there might be some movement on the margin. There's been some discussion that there could be a reduction in duties of tariffs on duties worth around $10 billion worth of Chinese imports into the US, but that is a drop in the bucket. To kind of put that into perspective, the tariffs that the US have on China target around $370 billion worth of goods, at least as of their values in 2018 and 2019. Most of these goods are industrial intermediate inputs. What that means is if you think about a phone, an intermediate input is the chip that goes with the phone. The finished good is the phone itself. Phones are not targeted by these tariffs, but some chips might be, or some LCD panels might be. Any kind of reduction in these tariffs is not going to have an immediate effect on the household consumer in the US, which I'll talk about in a second. But we are seeing this mostly as an issue around political optics before the midterms. So if we were to see Joe Biden act on this, it would essentially be framed in a way that the US administration is doing all it can to reduce inflation, to kind of counteract the effect of high prices on US households. What we're looking at in terms of the administration more specifically is who's leading this charge. So the US Trade Representative is the agency which is really in charge of these specific tariffs. They're called the Section 301 tariffs, and they are the key interlocutor. And then also USTR is the one who's the most hawkish in terms of preventing tariff rollback. The US Commerce and Treasury secretaries seem to be a bit more amenable in terms of pushing for tariff relief. But we haven't seen a decision, which suggests that things are still having a very heated discussion. That said, tariffs are a sideshow. There's so much else happening in the US-China relationship in ways that are much more worrisome to the future of economic and geopolitical ties. The US is maintaining a number of export controls, sanctions, financial investment prohibitions on China in ways that are much more consequential for the future of supply chains, as well as particularly US investment in that region. This is coming at a time when the US is shying away from regional trade deals. So we're not expecting the US to rejoin CPTPP, the Comprehensive and Progressive Agreement on Trans-Pacific Partnership. We're not expecting it to join the Regional Comprehensive and Economic Partnership, RCEP, the kind of China, ASEAN-led trade agreement in Asia. This doesn't mean the US is going to ignore the region. It's going to propose its own alternative trade frameworks in Asia, and we'll talk about this again a bit later. But this means that this idea of having to choose sides between a US-led order and a non-US-led order is intensifying. And I mentioned this in one of the previous slides, but this is one of the dominant themes that we're seeing emerging in ASEAN, this idea of having to choose sides. And I have to emphasize that this is the nightmare scenario for most ASEAN governments, which I'm sure people who cover ASEAN on this call know very well, but ASEAN doesn't want to choose. China is their largest market. The US is an important security guarantor and an important source of foreign investment. And so choosing between these two behemoths is something that no one wants. China is trying to fight this by pushing its own economic integration with Asia. It's announced its intention to join the CPTPP. It's finalized RCEP. There are a number of other trade agreements that are kind of floating in the background. And so this economic integration is going to be very, very important in terms of China's strategy to balance against the US. At the same time, China hasn't really been able to fully address the enlarging US security footprint in the region. And that's primarily because China has a lot of security issues with other economies in Asia. So the Taiwan issue is maybe the most obvious example of this. But we also have China's activities in the South China Sea, as well as various border disputes and maritime disputes, say with India, Japan, things like that. And so that really emphasizes the fact that other countries in Asia are going to be very, very concerned about China's geopolitical ambitions. And that's one of the reasons why they're going to be still very receptive to the US security footprint in that part of the world. Now, one thing that we're quite pessimistic about is that there's not really a lot of cooperation between the US and China on really issues of shared interest. So, for example, climate change, global health policy, anti-piracy efforts. These are all things the US has floated in terms of working with China, but China has pushed back a lot on this. And this is coming at a time when China's relations with the EU, Australia, Japan, South Korea are quite under strain. And so this geopolitical outlook is really threatening to overshadow a lot of what's happening in terms of the trade sphere, just because when you have the world's two largest economies bickering like this, it doesn't really pose a lot of really good optimism for how things are going to develop in the next 5 years. So let's talk a little bit about inflation and tariffs. So one thing that I want to mention, this is the most recent inflation print that we saw in the US. The drivers of inflation that we've noticed are not really tied to the goods targeted by the tariffs on China. You can see from this chart that a lot of this is really coming from energy commodities, food. We have some elements of this which are tied to the tariffs. So for example, new vehicles, used cars and trucks, there are US tariffs on Chinese auto parts. And so that could be kind of a pass-through effect there. But inflation really isn't being driven by this kind of trade war dynamic. And so market estimates expect that even if we do see tariff relief, it's only going to take off at max about 1% off headline inflation. And that's something that we are also we share this assessment in terms of the quantitative outlook. But I mentioned that Biden does have a political incentive to do this. One thing that we could see in terms of tariff relief might be exclusions rather than a rollback. So exclusions might be a temporary relief for, say, a year or so versus a permanent rollback. So let's keep an eye on that as things develop. And this is the last thing I want to kind of mention here is just a quick chart that illustrates inflationary trends in the US in the context of the trade war. And so you can see with this chart, it was in mid-2018 when we started the first of 4 tranches of US tariffs on Chinese goods come into effect. Inflationary readings, at least on a year-on-year basis, didn't really move all that much until 2021, 2022. That's when we started to see the effects of aggressive US fiscal stimulus in response to the pandemic. That's when we started to see issues around supply chains. And then, of course, in 2022, that's when we started to see really the issues around high global oil prices tied to the conflict in Ukraine. And so our kind of assessment of this is there's so many other things happening in terms of the inflationary environment. The tariffs are definitely part of that, but they're not the key deciding factor. And so even if we do see movement on this, we don't think it's going to be a big game changer for the region. So let's kind of talk a little bit more about trade specifically and think about where things are going to be going. So I mentioned these supply chain disruptions that were a big driver of inflation over the past couple of years. These supply chain disruptions, which include a shortage in integrated circuits, semiconductors, very high global oceanic freight rates, US port congestion, all the things which I'm assuming many of you have seen in the news. We're expecting a lot of these disruptions to persist in 2023. And a lot of this is tied to that zero COVID framework in China based on our assumptions that those zero COVID policies are going to persist until the middle of next year. We're expecting the trade picture in terms of volumes to remain relatively elevated over the third quarter of this year. And if we look at high frequency data coming out of China, South Korea, Taiwan, ASEAN, even import data into the US, into EU, import levels are still relatively high. And if we look at projected port volumes that are essentially forecast done by the US ports, the expectations of very strong trade levels are still there, which are going to kind of persist over the next couple of months. The third quarter is also the traditional season for retailers to stock up their inventory ahead of the Western holiday season, so Christmas. This, of course, is coming at a time when we're starting to see, big box retailers like Target say that they actually have too much inventory. But at least looking at the consumer inflation picture here in the US, consumer demand, again, is still relatively resilient. And so even if there are concerns around too much inventory, things still look pretty good. And so we're actually pretty positive and optimistic around the very near-term trade picture. That is probably going to change by the fourth quarter of the year. That's when we expect the effects of policy tightening to become a bit more pronounced. That's when you expect inflation to have a bit more of a depressive effect on household spending. That's when we expect economic certainty to start feeding into business and private spending, household spending plans. And that's when we're really kind of based on leading indicators like new export orders, et cetera, that's when we're expecting global trade environment to become a lot softer. So this is something that I think for anyone who's following the kind of global economic activity and whether trade is like a pulse of that, the fourth quarter is really the big inflection point that we're trying to monitor, even though there are risks that this could happen a bit more quickly, a bit earlier than we anticipate. When we talk about supply chains and trade more generally, we also need to talk about what's happening in terms of supply chain diversification. So I think for any analyst on this call who is looking at ASEAN in particular, this is going to be one of the main stories. This chart here comes from an EIU product called our Business Environment Rankings. It's baked into our country forecast product. And what it does is it assesses the kind of the attractiveness and the competitiveness of various markets across a number of key indicators. Now, I don't want to say that, I mean, it's too, there's too much nuance to say that the overall score means that some countries are more positioned for supply chain relocation than others. So for example, Singapore hasn't been as big a beneficiary of supply chain relocation as Vietnam has, but you can see when you go into the scores where some of these markets rank in terms of our assessments around market opportunities, FDI policy, the labor market, and infrastructure. So for example, Vietnam, which has emerged as one of the really big winners of trade diversification over the past couple of years, actually scores pretty bad in terms of infrastructure because so many companies have actually been diversifying into that market. And so Vietnam's ports and its roadways, they're all actually relatively overwhelmed right now because there's so much activity there. By contrast, a place like Malaysia or Thailand actually looks a little bit better. And so this is one of the reasons why we expect particularly ASEAN to take advantage quite noticeably of this supply chain diversification efforts out of China. At the same time, I want to kind of temper some of the doom and gloom headlines that we've been seeing tied to China over the past couple of months. We're not expecting a mass corporate exodus out of the Chinese market. Instead, we're expecting something called the China Plus One strategy, whereby companies keep their investments in China, but they think about expanding their footprint in Vietnam, Malaysia, Indonesia to ensure that they have what executives call supply chain agility, so that if things suddenly go offline, they can keep production kind of operating routinely. And this is going to be something that, as geopolitical risks kind of become heightened over the next decade, and with China at the center of that, that is going to be something that preserves a lot of this incentive. This ties into this idea as well with our outlook for FDI. This chart on the left just indicates that a lot of foreign businesses in China are souring on the Chinese market, but they're not leaving the Chinese market. They're definitely more unsure about prospects there. But this chart on the right illustrates our forecasts for FDI in terms of FDI inflows going into China versus ASEAN. And the key takeaway I want to emphasize here is that we are expecting to see more and more FDI diverted into ASEAN over the next 5 years, and that FDI differential between China and ASEAN is going to narrow. And that's particularly as we have supply chain and trade agreements like CPTPP, RCEP come into force and kind of harmonize a lot of the trade facilitation agreements that we have in the region in ways that make countries that may not have been as competitive as before, I'm thinking about Laos, Cambodia, much more competitive as we start to see things like unified rule of origin procedures, streamlined custom procedures, improved digitalization procedures, all of those things which are probably going to drive investments into ASEAN over the next couple of years. Finally, I know we only have a couple of minutes left. Let's have a quick discussion about the future of trade multilateralism. The thing I want to emphasize here is that the appetite for liberalization still exists, but it's changing. And when we think about what's in store for global trade beyond 2022, there are a number of things that I think are quite interesting to look at. So all of these charts look at some of the main groupings and frameworks that we're seeing currently in the Asia Pacific part of the world. So this chart on the right actually comes from a free white paper that I authored and we published in February. Actually, we published it the day before the war in Ukraine began. So it definitely got overshadowed by the news cycle. But for anyone who's interested in CPTPP, this white paper examines what our projections are for the expansion of CPTPP, as well as the potential members who we think are going to join. And that includes countries like Indonesia, the Philippines, South Korea, Thailand, Colombia. We're already looking at applicants like China, Ecuador, Taiwan, and the UK. This shows that there is definitely a lot of interest in joining and expanding kind of these trade frameworks, but it's going to be a very kind of different view over the next couple of years. for example, if China joins CPTPP, the quality of the agreement might actually deteriorate. But we can talk about that in the Q&A if there's any interest on that. This is coming at a time when we already have a number of other trade groupings in the region. So we have RCEP, for example. We have the long-established ASEAN, and you can see the overlay or the overlap of those countries in that chart on the bottom left. And you can see that, I mean, this is quite a nice illustration that there's, again, this real strong appetite for working together on this. The big question, however, is the role of the US, who is conspicuously absent in a lot of this. A couple of months ago, the US published its proposal for a new trade framework for the region called IPEF, the Indo-Pacific Economic Framework for Prosperity. And you can see in that chart on the left, kind of the potential members or the countries that have signed up expressing their interest. The issue around IPEF is that it's a relatively unambitious agreement. It doesn't present any new market access opportunities for Asian countries. There's no discussions around, for example, tariff reduction in the US market, because that would require congressional authorization, and trade agreements are very politically poisonous in the US government right now. But you can see that the combined trade values of these countries with the US versus the combined trade values of these countries with China are very, very different. And so this comes back to the theme that I've been emphasizing throughout this entire presentation, which is this dilemma of choosing sides, where the economic gravity of China in this region is just getting more and more important. China is becoming more and more entrenched in these supply chains at a time when the US is really trying to pressure companies and markets to diversify themselves and wean themselves away from the Chinese economic model. That is incredibly concerning, not only because the focus on security presents a lot of risks from miscalculation, say in the South China Sea or over Taiwan, but also because the US is not really proposing a very convincing alternative economic framework that might rival CPTPP or RCEP. IPEF essentially leaves a lot to be desired. And so a lot of the questions here are, this choosing sides dilemma would be made a lot easier if the US was actually bringing something a bit more to the table, but that's not happening. The last thing I want to mention is, again, back to this idea of the US-China rivalry derailing the Asian century. And so this is some of our kind of prospects in terms of how geopolitics might actually split Asia over the next couple of years. The things that I think we need to really watch out for are the formation of kind of these competing Cold War type blocks. We haven't seen that, even though there's been a lot of discussion around this. But we are starting to see elements around this unwinding of trade and supply chains, efforts by the US to bring back some critical manufacturing, say in chip making, back onto US shores, even though it's going to be very, very difficult. Where we're seeing this bipolarity between the US and China, which actually is already prominent in certain industries. So my favorite one to mention is the tech industry, where if you think about China, the tech ecosystem in China is just very, very different to the tech ecosystem in the US. When I was living in mainland China, I spent much more time on WeChat than I ever did on Facebook. And that is just kind of a microcosm of how the international kind of ICT environment looks vis-a-vis what's going on in China. And when you're talking about the second largest economy in the world, that has implications. So I think we're right at 45 minutes after, and that brings me to the end of the presentation. So I'm going to stop it there, and I will open it up to any questions that you all might have for us. So thank you so much for your attention. Hopefully that was interesting and informative, and hopefully we can have a bit more of a deeper discussion from there on out. Thank you.
Any questions for Nick?
Hello, I have a question here, if I may.
Yes, of course.
Yes, first of all, thank you to Maria and the team in the library for organizing this, and thank you for that wonderful presentation. I'm the economist at the UN office in the UAE in Abu Dhabi. And my question is if you've seen an increase in environment-related clauses or that kind of discussion in relation to trade agreement, trade discussions, negotiations, source origin, scope 2 emissions, or that sort of thing. And my second question, actually, two questions, is on the oil prices and how long do you expect oil prices to remain elevated in 2023 and how that links to chances of seeing a recession or not, and if we do see a recession, how far will that affect oil prices? I know nobody has a crystal ball, but a lot of the global south countries where the UN operates, the governments rely on extractive resources to determine the fiscal space. So any thoughts on that? Thank you.
Sure, of course. So I'll talk about the oil price first, and we'll talk a little bit more about what's happening in the environmental trade policy framework. So our forecast for a long time has been that oil is going to continue trading above $100 a barrel in terms of Brent crude futures for as long as the war in Ukraine is lasting. And so there are now what we like to call downside risks to this forecast. I'm sure many of you have seen oil kind of on this downward trend over the past couple of weeks, and that's primarily owing to fears of recession in the West, and just kind of a depressed natural demand as economies slow. And so I'd say the risks to this forecast are pretty prominent, but I would say that our commodities team is cautioning people to expect this high elevation of oil prices to persist for quite some time, at least until the end of 2022. With a high risk that this is going to go in 2023 and onwards. I think we're not expecting, at least if I remember the latest forecast that we have for a commodities team, we're not expecting oil prices to revert to the pre-war normal for quite some time. But we follow this issue very closely. And so after this, I'm happy to coordinate with Laura and send on some of our commodity forecasts with some specific numbers and charts to make sure that we provide you a very comprehensive answer on this. Because I think you're right, this is incredibly important for the Global South, as well as what this means for fiscal space, export receipts, etc. For your first question in terms of environmental policy and what's happening in trade, there is actually a lot happening here. So I would say that the EU is probably the one to watch here. So we have the carbon border adjustment tax mechanism, which is kind of coming to force the next couple of years. And this is a big issue of tension, particularly with palm oil exporters. So we've seen a lot of issues between Malaysia and Indonesia specifically and the EU, given that palm oil is a huge export from those countries, but the EU has criticized the deforestation tactics used in Malaysia and Indonesia as part of kind of palm oil extraction. And so I would say that if we're thinking about the future of environmental policy in terms of guiding trade frameworks, the EU is probably the benchmark to watch, particularly given that, to be completely frank, the rollback of the recent discussions on environmental policy in the US, for example, on the decisions by SCOTUS, are really complicating the US's, at least its optics around its commitment in this regard. The big caveat, however, is, as always when it comes to environmental policy, economic growth. And so what we're seeing right now in terms of the natural gas price shocks in the EU, the energy constraints that we're seeing as a result of lost supply from Russia, that's reopening discussions around coal, nuclear, these types of energy sources that the EU has long tried to move away from. And that is essentially because, for as much as we talk about climate policy, at the end of the day, governments care much more about keeping houses warm, providing economic opportunities for their populations, keeping incomes and employment robust. That's kind of the unfortunate reality. And I think that this is going to affect the enforcement of environmental provisions and trade frameworks, even if we start to see them appear a lot more on paper. I think another example of this, a great example of this, is China. For a long time, China has emerged as kind of this global defender of climate ambitions. So when I lived in Beijing, there were certain days where I literally couldn't see my hand in front of me because the pollution was so bad. But in the period from 2017 onwards, we saw a really strong push by the Chinese government to clean up the air. And I can personally attest to the fact that things did get better. That has changed since COVID. Because economic growth concerns have, again, forced the government to deprioritize these green goals. And when we look at things like the 14th Five-Year Plan and other policy documents, we can see a very noticeable deprioritization of all of this. I think China and the EU are great examples of this case study in action, whereby we see rhetorical commitments to green goals, and then at the end of the day, they get sacrificed for growth concerns. And so when we think about that and how it relates to trade, all of these issues are kind of interlinked. And so hopefully that can give us a good benchmark for where we think things are going.
Thank you, Nick. Does anyone else have any other questions? Utsu, if you can unmute yourself.
Yeah, thank you so much. My name is Casper. I'm here calling from also in Jerusalem in Israel. I'm not an economist analyst at all. I'm a military analyst, so we're looking very much at the conflict here. But I found your presentation, Nick, very interesting, and it's kind of also a personal interest of me to follow the economic situation, especially with covering Egypt down here, which is having some really economic hardship, right? And of course, uprising down here is on our radar and is our first priority. And I find it very interesting that you're talking about Asia, that behavior and sentiment is actually not following each other. And on that note, I was thinking, so even though that you don't see that Asia has directly been affected by the Ukraine crisis, I do see some second order effects in though that we have a very high debt levels at the moment, right? And I feel that, or I read a lot about that. A lot of this debt is really US dollar dominated, right? And just following what is going on at the moment, also with Sri Lanka, of course, but also other countries who are in a really debt mess, you can say. Can you elaborate a little bit on, even though we tried it before, of course, the dollar strength has been high before. What is your take on, the current environment? Because the GDP to debt is higher than we have seen before, right? And the dollar is really strong at the moment. Will this crash some of the countries that we see have uprisings at the moment?
Great, thanks for your question. I think you hit the nail on the head. The direct impact of the war in Ukraine in Asia, isn't really there, but it's those indirect impacts. So when we think about what's happening in Sri Lanka, for example, the global or the protests and the kind of the capitulation of the government directly tied to rising costs of living, and that is tied to rising food imports, energy imports, all of that. It's a similar situation that we're seeing in Pakistan, which is also on our radar, as well as Laos. So we're quite worried about what's happening in Laos. And what's also very worrisome about a country like Laos is that we don't expect the government to actually admit to the fact that it might default. And so that's an extra kind of added issue here in terms of transparency. I think when we're looking at this theme that I mentioned in the presentation in terms of the end of cheap financing, the strong US dollar, it's going to force a lot of economies to raise interest rates, maybe when they don't really need to. So for example, when I'm the analyst for Taiwan. We've noticed that Taiwan has also been hiking interest rates at a pretty, not to the same level as the US, but at a pretty rapid pace. This is happening at a time when Taiwan doesn't really need to be doing that. Private consumption environment is relatively weak. Business investment is still okay. Credit levels are elevated but manageable. But they're doing it because they need to keep up with the strength of the US dollar, because an economy like Taiwan is very, very exposed to high US dollar denominated food imports and energy imports. And so that is definitely the main thing that we're looking at, particularly when it comes to these emerging economies. A lot of these economies don't really have the space to raise interest rates. Because we're talking about this post-COVID recovery, but it really was supposed to take off this year, and then it didn't because of everything that happened in Ukraine. And so I think if the war hadn't happened, the global economy would be in a much stronger, firmer space for this tightening to occur. But this tightening is happening without a lot of these fundamentals, particularly in emerging markets, really being there. And so that is definitely one of the big things that we're looking at. And if you're interested, definitely look at some of our credit risk reporting, because these are things that we kind of highlight in terms of where these problem spots are starting to emerge. So I know you mentioned that you're stationed in the Middle East. We have a team that looks at this very closely. If you're interested, I'm happy to put you in contact with them to provide their outlook for example, what's happening in Egypt. But this is definitely going to be one of the emerging themes across regions in terms of these more expensive borrowing costs, pressure on emerging market currencies, very high US dollar, and then just the lack of space by governments to really respond adequately.
Thank you so much, Nick. Very interested, and absolutely, I would like to reach out to your department there. So I'll keep in touch. Thank you.
Right, sounds good.
Thank you. Anyone else has anything? If not, we are almost at the hour, so we'll end the session. Thank you very much to Nick and Dimitra for the very interesting presentation, and once we have the recording and the slides, we will send to all the attendees.
Great. Thank you all so much for your attention, and have a good rest of your day.
Thanks, everyone.
Stay cool.
Thank
Bye.
you. Bye-bye.
Bye-bye.
Thank you.